In January 1980, silver hit $50 an ounce. The Hunt brothers had cornered the market, billions in leverage, regulatory approval, the biggest precious metals play in history. 3 months later, silver collapsed 80% in 4 days. In April 2011, silver touched $49. Retail investors flooded in, ETFs expanded, physical premiums spiked, everyone saw the same trade. Within weeks, it fell 35%. Within months, it gave back years of gains. Here's what connects them. Silver doesn't crash from weakness, it crashes from crowding. The price can keep rising while the structure underneath changes. Leverage builds quietly, positioning concentrates, liquidity thins, and when the turn comes, it doesn't come gradually. Professional commodity traders know this. They call it a rolling top in a thin market. Price makes new highs, but breadth deteriorates. Open interest shifts. The plumbing changes before the headline does. In 2024, silver hit its highest level in over a decade. ETF holdings expanded. Retail participation surged. Industrial demand narratives strengthened. Positioning became one-sided. And the danger wasn't in the price. It was underneath it. Welcome to the wealth timeline, where money, power, and history quietly shape the world around us. Because what looks like opportunity to most investors is often the final stage of a pattern that is repeated for 40 years. And understanding that difference is what separates positioning from panic. Picture the silver market in late 1979. Gold had broken $500. Inflation was accelerating. The dollar was weakening. Precious metals had become the dominant investment narrative. Silver sat at the center of this, smaller market than gold, higher volatility, easier to move. And the Hunt brothers, billionaire heirs to an oil fortune, had been accumulating for years. By the end of 1979, they controlled an estimated 1/3 of the world's deliverable silver supply. Futures positions, physical holdings, coordinated buying through family trusts. It was legal, it was systematic, and it was working. Silver doubled in 6 months, then doubled again. By January 1980, it had risen tenfold in 2 years. At the time, this looked like a successful speculation. What no one questioned was the structure holding it up. The Hunt brothers' silver strategy began with a real concern. Throughout the 1970s, inflation was destroying purchasing power. The Bretton Woods system had collapsed. Nixon had closed the gold window in 1971. Fiat currency credibility was in question. Hard assets became the logical hedge. Gold was the obvious choice. But silver had advantages: industrial uses, monetary history, a smaller market that could deliver larger percentage gains. The Hunts believed they weren't just speculating. They were preserving wealth in real assets while the dollar declined. They had access to capital, they understood commodity markets, and they had institutional relationships that provided leverage. The strategy was rational. Futures contracts allowed them to control vast quantities of silver with limited upfront capital. As prices rose, their positions generated paper profits that justified additional leverage. Regulators saw concentrated positioning but didn't intervene. The Commodity Futures Trading Commission monitored the situation but took no restrictive action until late in the cycle. Market makers provided liquidity because the trend was intact, and volatility created trading opportunities. Each assumption was reasonable at the time. Capital was available, leverage was accessible, liquidity would remain stable. The market could absorb their positioning. It worked, but only under conditions that would not last. By mid-1979, the silver market had fundamentally changed. The Hunts weren't just buying silver, they were reshaping market structure. As prices rose, more investors followed. Retail participation expanded. Coin dealers reported unprecedented demand. Silver futures became one of the most actively traded contracts. This created a self-reinforcing cycle. Higher prices validated the narrative. Validation attracted more capital. More capital pushed prices higher. The Hunts' positions grew more profitable, which justified adding more leverage. Market makers accommodated because liquidity appeared deep and the trend appeared sustainable. But beneath this surface stability, concentration was increasing. The Hunts and their associates held long positions representing hundreds of millions of ounces. On the other side, commercial producers and industrial users held short positions for hedging purposes. But the short side was fragmented. The long side was concentrated. This was the unintended consequence. As silver rose, industrial users faced margin calls on their hedges. Some had to reduce positions. Some had to defer purchases. The natural counterparty base, those who needed silver for production, was being squeezed out of the market. Meanwhile, exchange officials grew concerned. The concentration violated no rules, but it created systemic risk. If the Hunts decided to take delivery on their futures contracts, the exchange might not have enough physical silver to settle. If they decided to liquidate, there might not be enough buyers to absorb the flow without a collapse. In October 1979, silver traded at $16. By January 1980, it reached $50. Prices were improving. The plumbing was changing. The stronger it became, the harder it was to stop. On January 7, 1980, the COMEX and CBOT exchanges announced new rules. Position limits were tightened. Margin requirements were increased. The stated goal was to ensure orderly markets and prevent manipulation. The practical effect was to target the Hunt brothers' strategy. The new rules didn't force immediate liquidation, but they changed the math. Higher margin requirements meant the Hunts needed more capital to maintain their positions. Position limits meant they couldn't add to positions even if they wanted to. At first, the market absorbed this. Silver pulled back from $50, but stabilized above $40. The Hunts had paper profits measured in billions. They had relationships with major banks. Additional capital seemed accessible, but the structure was already shifting. Banks that had provided credit lines began to reassess. The positions were massive. The concentration was unprecedented. Regulatory sentiment was turning. What had looked like a winning trade now looked like regulatory and credit risk. In late January, silver fell below $40. Margin calls accelerated. The Hunts needed more cash to meet margin requirements. They approached banks for additional credit. Some banks declined. Others demanded additional collateral. By mid-February, silver had fallen to $35. The Hunts' paper profits had evaporated. Their positions were still massive, but they were now underwater on recent additions. And critically, they were running out of liquid capital to meet margin calls. This was the mechanism that changed everything. As long as prices rose, leverage worked. As soon as prices stalled, leverage reversed. The same mechanism that amplified gains on the way up amplified losses on the way down. And in a concentrated market with thin liquidity, this created a feedback loop. Nothing collapsed. And that was the problem. March 27th, 1980, Silver Thursday. The Hunts had exhausted their available credit. Major banks refused additional loans. Botch Halsey Stewart Shields, their primary broker, faced its own crisis. The firm had extended massive credit to the Hunts and now faced potential insolvency if the positions failed. That morning, silver opened down. Margin calls came immediately. The Hunts couldn't meet them. Botch began liquidating positions, but there was no natural buyer. Industrial hedgers were already short. Retail investors had bought at higher prices and were facing their own losses. Market makers stepped back because the size of the liquidation exceeded their risk limits. The concentration that had pushed prices up now accelerated the collapse. Silver fell from $21 to $10.80 in a single day, a 48% decline. The decision to use leverage wasn't reckless by the standards of commodity trading. The decision to concentrate positions wasn't unprecedented. The belief that liquidity would remain available was shared by regulators, exchanges, and counterparties. But the system was built on an assumption that the market could absorb gradual position changes. That assumption broke when forced liquidation met illiquid conditions. The Hunts lost billions. Botch survived only through emergency intervention. The COMEX implemented additional emergency measures, but the damage was structural, not just financial. From this point on, the outcome was no longer optional. The immediate losses were extraordinary. The Hunt brothers personally lost an estimated $1.7 billion, equivalent to over $6 billion today. They eventually filed for bankruptcy. Their family's wealth, built over generations in oil, was permanently diminished. Botch required a $1.1 billion bailout, orchestrated by a consortium of banks and securities firms to prevent broader market contagion. Retail investors who had bought silver above $30 absorbed losses that took decades to recover. But the real consequence was not the wealth destroyed, it was the wealth transferred and the power that shifted. Commercial banks that had provided credit to the Hunts restructured loans and acquired hard assets as collateral. Industrial producers who had been short silver saw their hedges pay off dramatically. Professional traders who understood market structure and had positioned for crowding exhaustion profited from both the rise and the collapse. The regulatory response reshaped commodity markets. Position limits became standard. Margin requirements were codified. Exchange surveillance expanded. The CFTC gained authority it hadn't previously exercised. These changes didn't prevent future manias. They redirected them. Silver speculation didn't disappear. It became more distributed, more retail-oriented, and more ETF-driven. The concentration moved from individual billionaires to collective positioning through investment products. In 2011, the pattern repeated with different actors. Silver rose from $17 in late 2010 to $49 by April 2011. Retail investors piled in. The narrative was familiar. Inflation fears, currency debasement, precious metals as safety. ETF holdings expanded rapidly. Physical premiums spiked. Then came the margin increases. The CME Group raised silver futures margin requirements 5 times in 8 days. The justification was the same as 1980. Market stability, risk management, orderly trading. Silver collapsed from $49 to $32 in 5 days, a 35% decline. Over the following months, it continued falling, eventually reaching $26 by September. The mechanism was identical. Leverage, concentration, liquidity assumptions, forced selling. Only the participants had changed. Power quietly shifted, financially, institutionally, structurally, to those who recognized that precious metals markets are exceptionally vulnerable to crowding, and that regulatory intervention tends to come late in the cycle, accelerating rather than preventing dislocations. This is an ancient history, its current market structure. In 2024, silver rallied to multi-year highs above $30. The drivers were familiar: inflation concerns, geopolitical tensions, industrial demand from solar and electronics, and speculative positioning around monetary uncertainty. ETF holdings expanded. Retail participation increased through fractional shares and derivative products. Social media amplified the narrative. The silver squeeze movement of 2021, an attempt to force a short squeeze similar to GameStop, left residual positioning and community interest. But here's what matters. Silver remains a thin market. Total above-ground silver stocks are estimated at around 1.74 billion ounces. Annual mine production is roughly 830 million ounces. But the tradable market, futures, ETFs, allocated physical, is a fraction of this. A few $1 billion of coordinated flow can move prices significantly. This creates structural fragility. When positioning is one-sided, liquidity is an illusion. It exists when you don't need it and disappears when you do. This is the rolling top pattern in commodity markets. Price rises, participation increases, concentration builds, and the system becomes increasingly sensitive to any shift in flow. Prices are the headline. Plumbing is the story. Right now, several structural factors echo past cycles. Silver's correlation with both industrial metals and monetary metals has increased. This means it's sensitive to both growth concerns and inflation fears. But these can send contradictory signals. When that contradiction resolves, positioning unwinds rapidly. Futures open interest has grown substantially. This represents leverage in the system. Higher open interest with concentrated positioning amplifies moves in both directions. ETF flows have become a dominant driver. Unlike industrial buyers or long-term holders, ETF investors can reverse positions immediately. This introduces fast money into what was historically a slow market. The gold to silver ratio, a measure of relative valuation, has been volatile. When silver outperforms gold rapidly, it typically signals speculative excess. When it underperforms, it often precedes broader precious metals weakness. History doesn't repeat events, it repeats incentives. The incentive structure in silver hasn't changed. It's a small market that promises large gains, which attracts leverage, which creates fragility. Participants believe they can exit before the crowd. But in a thin market, the crowd is the liquidity. This doesn't mean silver will crash. It means the conditions that preceded past crashes are structural, not coincidental. They emerge from market size, leverage availability, and participant behavior. Late cycle psychology in commodities follows a pattern. Rising prices validate narratives, validation attracts capital, capital creates crowding, and crowding creates conditions where small catalysts produce large dislocations. Professional commodity traders don't ask, how high can silver go? They ask, what happens if everyone tries to exit at once? They stress test liquidity assumptions. They monitor positioning data. They size positions based on market depth, not conviction. Here's what matters for anyone holding silver. First, understand your liquidity reality. Paper silver, ETFs, futures, mining stocks can be liquidated instantly. But when markets are dislocating, bid-ask spreads widen dramatically. The price you see is not the price you'll get. Physical silver has the opposite problem. Premiums over spot prices spike during dislocations because physical inventory can't adjust as quickly as paper markets. If you need to sell quickly, premiums work against you. Second, recognize that silver's volatility is structural, not temporary. The market is too small for its investor interest. This means 30-40% moves in short periods aren't anomalies. They're inherent to the asset. Third, margin and leverage in silver are exceptionally dangerous. The 1980 and 2011 collapses were both accelerated by forced liquidations from margin calls. If you're using leverage, you're not positioned for volatility. You're guaranteed to experience it at the worst moment. Fourth, regulatory risk is always present. Exchanges can and will change margin requirements, position limits, and trading rules when they perceive systemic risk. These changes don't require legislation or advance notice. They happen when markets are already stressed, and they accelerate moves rather than stabilize them. Finally, understand the narrative life cycle. Silver rallies are always accompanied by compelling stories: inflation protection, currency collapse, industrial shortage, manipulation by short sellers. These narratives aren't false, they're incomplete. They describe why prices rise, but not why they collapse. The collapse comes from structure, not from the narrative changing. The yield curve in broader markets spent 2 years inverted, a signal of stress building in credit and liquidity systems. When it uninverted in late 2024, many celebrated. But uninversion doesn't mean safety. It means the stress moved. In precious metals, similar dynamics apply. When positioning becomes extreme, the stress is present even when prices are rising. The question isn't whether volatility will come. It's whether you're positioned for it or exposed to it. This is the distinction between investing and speculating. Investors own assets for reasons that don't depend on price momentum. Speculators own assets because prices are rising and expect to exit before they fall. In liquid markets with deep institutional participation, speculation can be managed. In thin markets with leverage and crowding, speculation guarantees eventual dislocation. Check this out. I've got 2 super important points to share with you. First, small markets cannot support large speculation without structural consequences. Silver's market capitalization is a fraction of gold's, but it attracts disproportionate speculative interest. This mismatch creates inherent instability. The market cannot absorb crowded positioning in either direction. Second, leverage in commodity markets is a timing bet, not a value bet. Even if you're correct about long-term fundamentals, leverage exposes you to short-term dislocations that can force liquidation before fundamentals matter. The Hunt brothers were eventually proven right about inflation and dollar weakness. But it didn't matter because they lost their positions in the drawdown. If you own silver, understand what you own. Physical metal owned outright is a long-term hedge with high storage costs and low liquidity. ETFs are paper claims with counterparty risk and instant liquidity. Futures and leveraged products are timing instruments that require active management and accept the risk of total loss. None of these are wrong, but they're different. And in volatile markets, different means everything. You don't need to predict the next move in silver. You need to know what happens to your position if volatility spikes 50% in a week, if margin requirements double overnight, or if liquidity disappears when you need it most. That's not pessimism, that's positioning. If this helped you see the system more clearly, subscribe to the Wealth Timeline. Because the next story won't predict the future. It will help you recognize it.